Welcome back to Real Estate 101. Today we're going to continue our discussion on financial planning and talk a little bit about year-end tax planning tips. And I'm pleased to be joined once again by Jeff Gregory of Desjardins Financial. Jeff, welcome back to the show.
Thanks for having me again, Joe.
All right, Jeff, so I want to start today's show and I want to ask you, do you have maybe a tip for someone who's preparing their year-end in order to avoid a huge tax bill?
Yep. One really good tip that I think a lot of people don't take advantage of is some loss selling right at the end of the year. Everyone probably might have an old Nortel stock somewhere, or everyone thought buying back into BlackBerry sometime this year was a good move, and they've got some losses. The best thing to do is try and trigger those losses. Sell it. You can get back in within a couple of days or 30 days or so forth in a lot of investments. But what you've then done, and the reason for having to wait 30 days is CRA kind of goes, if you want to trigger your loss, keep the loss. But losses get to carry on forever. So when you do get that capital gain, when you use people like myself and can help you make money, what then you're able to do is use that against the losses and keep it tax-free. So you have to do this probably around the 18th and 19th of December. Have a pretty good idea what you've lost, trigger it, get back in or buy something else completely, and just keep your capital loss going on forever. That's one of the best tips a lot of people don't take advantage of.
All right, and what about tax-free savings accounts?
If you're going to be using your tax-free savings account at any time next year for maybe you want to go on a trip or you're using it for a big expenditure, you should make as much of the contribution towards the end of the year as you can. What happens is if you take the money out and you put the money back, you can create an over-contribution situation, and the government will penalize you. Even though you didn't add more to your tax-free, you just put it back. The way the rules are, you have to wait a full calendar year to put a lot of the money back. So if you get it done sometime in November, December, you haven't lost the room, it restarts in January, you can take out the money that you need. It needs a calendar year. So try to lump sum or get as much in your tax-free towards the end of the year so that you don't hit an over-contribution situation in the following year.
All right, Jeff, so what about for viewers of our show that may be retiring this year before the end of the year? Do you have any suggestions for them?
Yep. If you're going to be 65 this year or you were into next year, make sure you apply for your old age security. There are some rules coming down in the next few years at old age security that people should be concerned about, but the age change from receiving it from 65 to 67. Somewhere when you're born, somewhere in the mid-late 60s, if that's your birth date, do come to talk to myself because your retirement planning is altered a little. The other part that people should look at doing is if you're between 60 and 65, look at taking your Canada pension a little bit early. They're changing the rules again. The pension system in Canada is at a bit of a strain. We're becoming a lot older and the government's very condescending of this right now. So what they're doing is there used to be a penalty of 0.5% a month, depending on the age you take it, or effectively about 6% a year. What's going to happen now, instead of 0.5% a month, they're making it 0.6% a month. So if you retire earlier or you wait that out, you might not get maximum pension. You really want to take a look whether you should get your CPP early versus waiting to 65 if you can, because they are making it a little bit more expensive to get that ahead of time.
And what about for viewers with young families? Do you have any recommendations for them?
Yep, oh certainly. Towards the end of the year, make sure you get in your contribution for the Registered Education Savings Plans, the RESPs, $2,500 per child. If you don't get that $2,500 in and maybe you didn't do it the year before, you're only able to get caught up on $5,000 or 2 years. So if you get it in, if you get your $2,500 or you get your $5,000 to catch up on previous years, and you can do another $5,000 in January, be careful not to do your lump sum all at once because you could lose out on grant dollars. So get that in towards the end of the year. And the same thing with registered disability savings plans. The same rules kind of apply. They'll only let you go so far back. So by December, if you have catch-ups or you need to put the money into it, get it done by then.
All right, so what are some things that people need to contribute to before the end of the year?
There are some things within the tax system that you have to do by December 31st in order to receive your claim. Things such as charitable donations. political donations, which actually, believe it or not, are a little more lucrative than charitable donations. Investment counseling fees, safety deposit boxes, any alimony payments you need to do, or childcare expenses. They should be done by December 31st in order to claim. You can't go back in January, February and use those claims back. So make sure that if you're putting your kids into any activities, arts or fitness activities, so you can get that full $500 claim, has to be done by December 31st.
All right, so are there any things that are purchased by individuals or business owners that can be written off?
Yep, some capital expenditure stuff. So say you're looking at getting some new furniture in your office, or you need a new computer because it's starting to wear down, or you have an old ColecoVision type of thing going on right now. If you buy that and have it all set up before December 31st, you get to write off probably about 50% of that. So you're going to spend 1 month of usage and get 50% write-off. That's a pretty good deal for a lot of business owners to get, and most of the times, if you are going to buy anything, always try to buy it towards the end of the year because you'll be able to maximize your write-off.
All right, and what about RSPs and stuff?
It is going to be March 1st of 2014. It's about $23,000 for the maximum contribution. So if you don't have it by December 31st, it's okay. You have until the end of February, but take your pay stub. Take your last pay stub, talk with someone like myself. There's a lot of calculators on the internet, and enter how much you've done, how much you've done in your taxes, and how much you can contribute to an RSP. You'll actually see what your refund will be before you even get to that March 1st deadline. Or even look at an RSP loan and try to up that even more. There's a lot of tricks that you can help to advance your retirement from what you're regularly contributing. Around December, though, I get a lot of pay stubs towards the end of the year to help people figure out how much they need to do or what's going to maximize their RSP contributions.
All right, Jeff, so any last tips for viewers of our show?
I wish I could say there was only one, but there's a lot of tips that are available towards year-end tax planning. And don't take tax planning as something you're supposed to worry about in November, December. Tax planning is supposed to be done throughout the year, and a lot of planning that could be done now will be into effect for next year. So what I really strongly suggest is sitting down with a professional like myself and planning this out. Let's take a look at what your situation is to see what we can maximize going forward, not this year, not next year, but for the next 30 plus years, 20 plus years, 10 plus years, however long you will be here on this earth, I don't know. But every dollar you don't worry about with tax planning, the government will not tell you. They won't kind of take your return back and go, oh, you forgot to claim this or you didn't look at this. That's not their job. The responsibility is back on yourself, and using individuals like myself or an accountant and so forth can be hugely beneficial to your viewers, to the viewers out there, because it's money back in your pocket, and I'm going to assume it's probably better in your pocket than theirs.
All right, Jeff, great stuff. Thanks for coming on today's show. You brought a lot of good tips. I'm looking forward to seeing you again next month.
Thanks, Joe. Appreciate it. Can't wait to get back.
So if you need any help with your year-end tax planning, get in contact with Jeff Gregory at Desjardins Financial. I'm your host, Joe Terceira. Thanks for watching, and we'll see you next time.